Can you guys hear me?
Yes, Professor, I can
Hello?
hear you. Yes,
Can you guys hear me?
Yes.
Yes, we can. Can you hear us?
You can hear me. Say something. One of you say something. No, I can't hear you guys.
We're trying to
I
talk to
can
you.
I can hear you, Professor.
You can't hear us?
Let me sign in and sign back out. No. Say something, anybody.
Hello, hello.
Hi, good
Okay,
evening.
got it. All right. All right, good. No, I had another class. We had a midterm, so I had to see it finish. So, all right. Tonight we're going to go over the homework, and then after that, I'm not signing the quiz because we're running a little bit ahead of schedule till next week. And then we will start lecturing on the other chapter. All right? Cool? So this weekend you have off.
Professor, but the quiz is active, right?
No, it's not. I took it off.
Oh, you took it off. Okay.
Look, you see it?
At 7 I was able to see it, but I did not check it now. Let me check.
Hold on. The quiz, really? Yeah, but you don't see it till 4:20. 4:20 is next week, right? What dates do you guys see for the quiz?
Yes, 4:20.
Okay, so that's next week.
Yeah, yeah, it's not. I thought it's active and
No.
due on 4:20. But yeah, I saw it. Thanks.
Okay. We'll start in a couple of minutes. Um, Everybody did really well on the homework. Just about everyone. I was really happy about that. Now I want to see the same thing on the exam. Because when the pressure's on, I want to see the same thing. Um, Basically, exactly, exactly. Um, Basically, what we're going to do tonight is just go over the homework and any questions that you have or concerns. Let me know what you don't understand. Excuse me, and that way we can go over it. And then now we're just going to go over the homework, and I'll show you a couple of things that's going to happen in the future, just a couple of problems, and then that's it. All right. So give everybody a little break here. All right. Let's start. Hold on. Nope, I didn't do it yet. Give me 1 second. Can you see this?
Yeah, we can see.
Yes.
Okay.
Yes.
So when you're looking at these problems, right, and I always say when you're doing the homework, you have help in all these things. And then when you do the quiz or when you do the exam, you have pressure, right? Because you start second guessing yourself, right? That happens a lot. And one of the ways to help with second guessing is to be comfortable and to understand the logic behind it, right? So here it's asking you, you have consider a 10-year bond with a face value of $1,000.
Sorry,
It has a-
Professor, we're not seeing that. We're seeing your, I don't know, assignment manager.
Okay, hold on. How about now?
Yes, we can see.
Okay. So when you see this, right, anytime you see anything excuse me, that says semi-annual, anytime you see that, you know that time, the time is doubled, right? In other words, your calculation is going to be twice whatever the bond is for. So if it's a 10-year, that means N is going to equal to 20. If it's a 20, N is equal to 40, and so on. If it's a, I don't know, 50, I guess it's 25, or, right, if it's 25, it's going to be 50, right? You know, whatever it is, it's going to be double, right? And then you know that calculating the coupon, right? Common sense is going to tell us 5.5%. 5.5% is $55, right? 5.5% of $1,000 is $55. And you see semi-annual, so you know that's half. So that's $27.50, right? Think logically. Don't start thinking about maybe it's 55%. No, a bond can't be for 55%, right? Unless it's some kind of like high yield thing that somebody's trying to get you to buy, and I wouldn't touch it with a 10-foot pole, right? So the same thing happens here when you see these numbers, right? Common sense would say to you, it can't be 55%. And I've seen stuff like that on the exam. And I said, oh my God, right? And then what happens too, you start calculating annually instead of semi-annual, and it's right there, right? When you're doing this with help and there's no pressure, right? You do well. You do well. And this pandemic, right? The thing that helps a lot of students, if you can't get good grades during this pandemic, right? Where you have access to a lot of things, and you can do, you have a lot of time on your hands to study, you have a lot of times to research stuff, right? This is the time to do well, right? And what happens, I see it all the time. People get ahead of themselves. They start doing well, right? And then they start to slack off instead of stepping on the gas. And then what happens is at the end, they don't do well on the final. And then they start sending me emails telling me, I know the work. Well, guess what? I can't go by what you think I know you know. I got to go by what you've done on the test. Right? And I know most of you do understand this stuff, but I can't go by that. If that's the case, then everybody should get an A. Right? So that's what I'm saying to you. Don't, if you did well on the midterm, I see people are not showing up. That's your choice. You're an adult. I don't know what your situation is and all that, but don't get ahead of yourself. And please do not send me any emails. I'm recording this so we get ahead of this. Do not send me any emails telling me that, you should have gotten a better grade. I don't make up your grades. You do. So this right here is the Holy Grail, and that's it, right? Another thing that's going to happen is the homeworks that weren't done are going to get zeroed out, right? Are going to get zeroed out. So that's going to bring down the score, the average again, right? We don't have that issue here, but whoever hasn't been doing their homework, right? Whatever score you have, that's not your real score. And I'm not opening up homeworks from like 1, homework 2, 3, 4, 5. I'm not doing that. That's done. We passed that. The midterm is gone. So my advice is to start doing your homework if you're not doing it, because I don't have any extra credit. That's your extra credit, right? Okay, so let's continue. So on this one is you have to show the cash flow, right? When you buy a bond that has a coupon, at the end of the life, when the bond matures, the life of the bond, when it's done, you're going to get your face value, right, plus your final coupon payment. That's with any bond. Remember what I said, these two things don't change. The price of the bond can change, the rate, the yield to maturity can change, but the coupon and the face value does not change on the bond. Now, if they brought something out new that I don't know about, I don't know. But as far as I know, so far, those two variables, or those two are fixed. No variables. Those two are fixed. That's it. They're constant on the bond, right? So when you see this, anytime you see, one more time, anytime you see semi-annual, you know that whatever the bond, the term of the bond is, it's double. Every time it has a coupon, it pays double, right? And a zero coupon bond wouldn't have anything semi-annual. You just buy it at a discount. You buy it at a discount, right? And then when it matures, you get your money back plus interest, right? So if you bought it at $900 and at maturity they give you your 900 plus 100, and they give you what the face value is. That's how bonds work, right? Here, the same thing again, right? This is good. This is showing you another one, right? This is asking you, what is the maturity of the bond in years? So I told you before, if it's 50 semi-annual, that means that it's 25 years, right? The coupon rate, right? I'm going to say 19.37 times 2, right? Because it's semi-annual. 19.37 times 2 divided by 1,000 times 100. You could do it that way, right? And the face value is $1,000. And as you can see, the same thing applies again at the end of the term. At maturity, you're going to get $1,000 plus $19.37. Now, when you go work for a firm, the reason why we make these $1,000 is because it's easier for you to understand. You're going to see denominations that vary. 38 million, 40 million, 70 million, 80 million, depends on who's borrowing and who's issuing them, right? It could be for any amount, right? Usually they're an even amount, meaning 5,000, 50,000, whatever it is, but you never know. You never know, right? And we saw that with the 9 million, 7 million, whatever it is, right? We need to know the future value, what we're going to make the face value for, right? So those things are going to happen, right? So now you have an idea of how to calculate a bond. You have an idea now. And by the time we're done, you're going to know all these things also. So let's look at the third question, right? So here's a quick example of what I'm talking about. And this is the kind of bond that you're going to be dealing with when you work for a firm, right? It could be even higher. It could be $1 billion. It could be 1.5 billion, or it could be 15 billion, not 15 billion, excuse me, 150 million or 1.5 billion, something like that. Could be, right? Large numbers, real large numbers. 150, you never know, right? So here, the company wants to raise $8 million by issuing a 10-year zero coupon bonds, right? So we right off the bat, and it's 7%, right? So it's going to be N, right? Number of years is 10, the interest rate, right? No payments are involved here, right? We have the present value of 8 million, and then we compute for future value, right? If I'm borrowing 8 million for 10 years at 7%, right? I know that this number should be double by the rule of, what's that called again? The 70 rule. I know that this is going to be almost double, right? So we know that at 10 years, right, we're going to say this is what's going to be on the face value of the bond, this amount right here, right? And this is the price of the bond. And this is the yield to maturity is 7%. On this one, there is, or there aren't any coupon payment. Zero, right? You go in, you buy your bond, right? And that's it. And I told you a bond like this is going to be changing hands over and over, right? The way they'll calculate it is that if it's 10 years to maturity, you calculate how many years you've used it and what's left as the present value. So I had it for 2 years, I'll calculate 8 years. And then it'll tell me the amount that I'm going to be charging whoever wants to buy the bond from me. And that's how it works. I'm end up, and it might end up being back in my hands 5 years from now, because that's how those things work on Wall Street. This one is, this one I always have this on the exam. I always have this on the exam because this one is that shows you how to calculate the interest, right? The interest, the yield on the interest. And where people always make a mistake on this one, the mistakes that people make, right here. They round to 3, they make up their own numbers, they use the wrong calculator, and all of a sudden all hell breaks loose, right? I'm not marking these. So this one, they have the face value there. The face value is right here, right? Someone asked me that the other day. How do you know it's $100? The face value is right there. And what we're going to do, we're calculating for interest, right? On the first one, n equals 1, right? And then we leave IY alone, right? Present value is negative 95.1. Future value is 100. Remember that whenever you're doing a calculation on the calculator, if you're given the present value and the future value, right? Usually, and the present value is always negative because you're out the money, right? So you always put negative so you understand the concept. You always put negative when you're calculating this bond right here. These bond prices. The 1 year, the 2 year, the 3 year, and the 4 year, right? And as you can see, the interest rates are going up, right? The curve, the yield curve, right? That's what they call it on Wall Street. The yield, meaning what it's giving back, the curve, what it's measuring, right? The curve, what it's measuring, yield, what it's giving back, right? As far as the interest is concerned, right? So now we go in and we pick out the right one, which is A, right? And then it's an upward slope. Now, I want you to know something about my lab. And I know you know this. Just because we've seen it sloping up doesn't mean it's always that way. Because the question sometimes changes. Because remember, it's on an algorithm. So there are times it makes its own mind up. And I am not the one saying it. But if you know the concept, you won't panic. You won't panic. Once you do it, right, you say, oh, the interest rate is going down. Okay, well, I'm good with that, right? And so, yes, someone said something? Oh, hold on 1 second. Right? So the interest rate is going down, then it'll be on this side, right? If this was going down. And it can happen. Same thing when we did, excuse me. Same thing when we did the interest calculations on the credit card. Do you borrow from your parents or do you borrow from the credit card? Right? And many times the equation's added to the parent. And a lot of times it added to the credit card. It was not always the credit card and it was not always the parent. Same thing here. So keep that in mind. Okay? So the yield to maturity of a $1,000 bond at 7.3 coupon rate, semi-annual coupon, and 2 years to maturity, right, is 8.4 APR compounded semi-annually. What is the yield? What is the yield price? What is the price of the bond? Okay, what's the yield? I'm sorry, not yield. What is the price of the bond? So right off the bat, I can see it's semi-annual. It's 2 years. So 2 means 4. So I know N is 4, right? And I know that the APR is 8.4. So that means it's 4.2 as far as the IY is concerned, right? And I could see that the coupon is 73. So half of 73, 150 and 35 is 36.50. That would be my payment. My future value is 1,000, and then I compute for payment, present value. Excuse me. I compute for present value. So this is how this is going to be done, right? And I know if I had this on the exam, I would say about half of the class would get this wrong right now, if this was an exam. Without any help, nothing. Here's the problem, you do it. About half the class will get this wrong. Okay, so here, what happens here is, suppose a 10-year $1,000 bond with an 8.3 coupon rate, and semi-annual coupon is trading for 1,035.59. So we're trying to calculate the compound yield to maturity. So compounds mean what it is for 1 year, not what it is for semi-annual. So whatever answer I get, I must multiply it by 2 because I'm solving for IY, right? So it says suppose a 10-year semi-annual, so automatically I know N is 20, right? I'm solving for IY, so I skip, right? I go right into payment. So the coupon rate is 8.3, right? So that means that the payment is going to be $41.50. Okay? Payment is going to be $41.50. Present value is going to be negative 1,035.59. Future value is going to be 1,000. And then I compute for IY. And then if I say 2 times 3891, I come up to 7.78, right? But I must double it. I must double it because it's asked me express as an APR with semi-annual compounding. So this is twice. This is where the mistake happens on the exam. This answer gets put in. It doesn't get doubled. Or they made the coupon payment $83 instead of $41.50. And the whole thing is wrong. Right? Now the second part is asking me if I change the APR to 9.9, which is half of that, right? Which is $495.20. Everything stays the same except for this. Now I'm calculating the present value, right? As I said before, your coupon payment never changes. Your forward value, future value, face value never changes. And then I calculate for the present value, right? This is the price of the bond. Right here. Okay, so suppose you have a 5-year, $1,000 bond with annual coupons has a price of $8.99, yield 5.7. What is the coupon rate? So here we're going to calculate for payment, right? And once we do that, right, and all we have to do is divide it. Once we know it's 33.41, we know that it's 3.41. 3.341, right? Because it says 3 places, right? So we calculate for payment. If you know the payment, you know the coupon rate. If you know the coupon rate, you know the payment, right? So you see this on the test, right? Take your time, right? You see you come out with 33.341. You're not sure, right? Divided by 1,000, and just move the decimal place 2 places to here, and you get that 3.341. and it says 3 places. Okay, this is your give me question on the exam. This is your give me question. This one, I would say there's 33 of us in the class, 37. About 10 people will get this wrong, right? So we have anything, the way it works, right? For each state, whether it trades at discount or par. When you have the face value of 1,000 and you pay less than 1,000, it's a discount. When you pay more than 1,000, the face value, it's at premium. And when you pay the same price, it's at par. Okay, above is premium, below is discount, the same as par. So suppose that General Motors Acceptance Corporation issued a bond with 10 years until maturity, a face value of 1,000 and a coupon rate of 7.8 annual payments, right? The yield to maturity when it was issued 6.1. What is the price, right, of this bond when it was issued? Okay, so here this is straight up, as we say, straight up, right? N equals 10, IY equals 6.1, payment is $78, future value is 1,000, and then compute for payment. That's it. That's it. This one I told you, the reason why you add the spread to the annual coupon rate, right, is because you want to attract people to your bond, right? So what you're doing is that you want this yield to maturity, right, to be higher than the risk-free, right? The credit spread. Why would they come to you when they can go to the American government and get this, right? You have to make it more attractive, right? And of course, yes.
So the reason why just to make sure, the reason why we're adding that 81 basis points to the new coupon rate is because you just want to make it more attractive because it's much lower than what it was before.
No, much high. No. This is a spread,
Mm-hmm.
right? So this is what the Treasury is offering, right? You want to make yours 2.41, so you make it more attractive. Because why should they come? It's like this. If we have a store in our neighborhood, right, that's selling milk at $1.60. I'm sorry, they're selling milk at no. Let me make it better. They're selling milk and at $1.60 in your neighborhood, right? Now, in the next neighborhood, when you go buy the milk, they give you 81 cents for each gallon of milk that you buy. Right? Do you understand what I'm trying to say? So what would make you go to that another neighborhood is to get this additional 81 cents, right? Do you understand what I'm trying to say?
Yeah, I kind of get it now.
You get it? In other words, the incentive. What would make us change our mind, right? Like I was explaining to someone today, we were talking, I read something, right? I was explaining why Amazon has such a big impact, right? Because it covers all the bases, right? One of the things that make it so attractive, why people like going on Amazon, it covers all the bases. Whatever, just about whatever you're looking for, you can find on there, right? They have not a monopoly, a monopoly, right? Where they're the only place you can go, right? They don't have too many shopping, or how would I say to you? They don't have too many things like Amazon. There aren't any, to be honest, at that level. So, all these small shops are going to them. It's like a one-sided market. And I'm pretty sure one day they're going to clip their wings. They're going to break them down, because they're killing people. But getting back to what I was saying, we were saying here, and when you have to make this more attractive so people can come and, buy your bond. All right. Yes.
So I know how to do this question thanks to you. But what I don't get is like on the test, I don't see anywhere in the question where it says future value is 1,000. Would we have to just like know?
No, yeah. Yeah. Alexis, listen to me. This one right here, right? We know that we're dealing with 1,000 bucks, right? And always remember that, right? And the other one that says 100 tells you 100. This is the
Gotcha.
increment we're dealing with.
Okay.
Okay? All right. Yeah, I get it. Okay. I wanted to show you something. Hold on one second. Hmm. Uh, okay. In our next, can you see this?
Yes.
Okay. So our next chapter, I'm not going to say anything yet because we're moving a little bit fast. Because I want room to really go over this, right? We're going to be dealing with earnings per share. We're going to be dealing with retention rates, equity, and cost of capital. All these little things grow forever. We know about those things. And what we're going to do is we're going to do these calculations that we already know. We already know some of them, right? And when we get to this chapter, right, a lot of these equations they're very similar to what we've been doing, but it's just that we have to do the calculation in a different way, right? So this one is calculating a stock price based on the earnings that you receive, right? It's calculating the stock price based on the earnings that you receive. So as you can see, the 408 is what you get for per share, right? The earnings. And then the company decides that they're going to keep 30% of it. And then, of course, once you get that answer, we have the rate, which is cost of capital, right? And then we have the grow forever. So we know from past experience, right? We know that is growth minus rate, rate, interest rate minus growth. And then what we're doing here, we're saying the same things, right? We have earning retention of 30%. So we want to know how much, not the 30%, but how much is left over when we do it. So the price will be like 70% of this. So it's going to be 1 minus 0.30, which is 0.70 times 408, and then it's going to give us the share. Once we know the share, we can calculate the price. We can calculate the price based on the cost of capital, right? And then the growth, which is 2.7. Those are the same formulas that we were using before, right? Those are the things that we're going to be doing, right? They're going to be more, they're going to be some that are, it's going to be a little harder than that, but I just want you to see that, right? And then show you a couple more. Same thing here. And this will be to the 4th power. I don't want to really get into that right now, but we're going to be using stuff like this, right? This is telling you that it's going to grow per quarter. So we do the same thing, same type of formulas, right? We divide 1 by 4, so that's going to be 0.25, and then we multiply that to the exponent of 0.25 minus 1, and then we divide it by the interest rate that we got right here. And then we can come up with the stock price. Now, these are the things that when you work at a firm that you must know how to do, right? They have a computer, they have PCs, and they have things that you just plug in. But you have to know what's behind what you're doing, meaning how it's calculated, so you understand it. In case there's a mistake, you know how to fix it, right? But this is how you calculate a stock price based on the information that you got, right? So this is quarterly, right? Current pays dividends per quarter. So this means every 3 months, and it will continue paying this dividend forever. However, in this formula right here, there is no growth. It's just this amount. So what this means is that, right here, I'm sorry. This means that we're going to calculate the amount that we receive, the dividends, which makes sense. 0.47 is a real dividend, because keep in mind that when you buy a stock, right, there are millions and millions and millions of shares, depending on the company, right? So based on that, based on that, let's say the company made for that quarter, let's say 380 million, and they had to split that into millions and millions of shares. Each share will receive 47 cents. That's how it is. And then what happens when people have a lot of shares, what they do is that they reinvest the dividend payments that they receive to buy more shares, right? So if somebody had, for instance, 1,000 shares, right? This would be probably $47 or something like that, if I'm not mistaken. Or yeah, probably $47, right? And they buy more shares, or 400. It wouldn't be 470. Maybe, yeah, it'd be 470, right? 40% of 1,000 be 470, right? So they would reinvest it. They would reinvest it because each dollar is like 47 cents on the dollar, right? So if it had 1,000, so they would get, 470 if they had 1,000 shares. I'm just saying, and then that way, whatever this was, right? They buy more shares, and that's what companies do. Like when Citibank or Chase, they buy these big blocks of Nike, of Apple. They don't take the money; they reinvest it, right? They don't want the money; they want more shares, right? I'll show you something. Something like this, right? So if you own like 17,000 shares of stock of Nike and it pays the dividend of 28 cents, very realistic, very realistic. 28 cents is something. That's why sometimes when you see they say it expected earnings were higher than expected and they're up 2 cents, and you're like, what? What does that mean? Right? So it could have been, instead of 28 cents, it's 30 cents, but on millions of shares. So this individual, right, owns 17,000 shares of Nike. He might be a wealthy individual, might be someone who bought them when they were just starting. He probably bought maybe 1,000 of them, and they just kept growing, and they kept, remember now, the stock splits, which means that they give you 2 for 1, right? So 2 for 1, you get 2 stocks for the one that you had. So if you had 1,000, now you have 2,000, and they start growing again, and then they split again, and then they split again, right? So that can happen, right? So 17,000 times 0.28, right? And it comes out to 4,760, right? So this individual or this company, small company, they're not going to take the money. They're going to say, buy us more shares of Nike. So 4,000 probably buy maybe 30, 50, 60. I don't know how much Nike is selling for. I don't know. But they'll buy a nice little amount, and it adds to this. So next time again, same thing. So by maybe 3 years, this goes from 17 to probably 20 or 21. And then it keeps growing. So that's going to be the next chapter that we're going to be going through. I'll show you one more thing, and then I'm going to show you one more thing. Hold on. One of the things that can you see this page before I can start talking?
Yes, yes.
Okay. So one of the things that we are going to learn is what this whole thing is all about is the net present value, right? So in this situation, right, we're calculating the net present value, right, of any investment that we make, right? Is it better or is it not worth having or worth doing? So when we start calculating net present value, right, that's what we're going to be getting into, right? That's what we're going to be getting into. And you're going to see that a lot. It's the same things that we're doing, but this is what this whole course is all about, in a nutshell, about what we invested and how do we make money for the company that we work for, right? You have an opportunity to invest $49,000 now and return for $59,600 in 1 year. If your cost of capital is 7.7%, what is the net present value of this investment? So the net present value of this investment is $6,000, $338, because they're giving me $59,600. I'm investing 49. So this amount that I'm getting right here, 59,600, this amount right here, the present value of it is higher than my initial investment. So of course I'm going to do this deal. Why? Because this deal is going to add value to the company, right? It's positive. It's a positive number, right? It's going to add value to it. These are the same equations that we were doing at the beginning with the guy with the wanted to invest in his friend's landscaping business. But this is about investment. This one's about investment for a company. Now, I'm going to tell you something, and see how easy we're doing these things and all that. When you have an exam and you have a lot of different questions coming from various chapters, and especially in an exam where questions are scrambled, right? This chapter, you're doing chapter 5 on the first question, and on the second question, you're in chapter 9 or 10, right? Once these questions get scrambled, you got to be able to do it because you understand the concept behind these questions, right? Same way we just did this right here. We went from chapter 6, chapter 7 to chapter 9 to chapter 8, right? Chapter 9 has a couple of some challenging questions on there, but the thing is that we're going to practice, and we're going to practice, and we're going to practice till we get good at it. And once we get good, then I've done as much as I can. And that's all I have to say. All right. So that being said, we have a little break for the weekend. I did not assign the quiz. The quiz will be assigned on Tuesday, right? We will start the new chapter, but we're going to have a lecture on it first, and then we'll take it from there. All right. Have a great weekend, and I'll see you guys on Tuesday.
Professor, when it
Professor.
says assign Tuesday, is due on Tuesday?
No,
Oh,
it'll be
okay.
assigned on Tuesday. All right.
Professor,
Yes, sir.
can you stick around? I would love to talk to you one-on-one after everyone leaves, please.
Okay.
Thank you, Professor. Enjoy the weekend.
Bye, my dear. Take care. All right.
Have a
Thank
good
Thank you,
you.
weekend.
Professor.
Professor.
Have a good weekend.
You're very welcome.
You can just kick those guys out, Professor, if they're not. I don't think they're sitting, because I don't think they're sitting on their laptops or
Oh my
whatever.
God. Oh my God. All right. What's going on?
All right. I just want to start off by saying, I appreciate your class, Professor, and I appreciate you personally because the way that you teach the class is very easy to understand. Um, at the beginning of this course, I was doing very well. I was actually doing extremely well. I think, according to Pearson, because it tells you our grades, I had almost like a 90 average, 90% over there. You know what I mean? And then the day the day before the midterm happened, my father was in a very bad accident. He had a heart attack on the highway and a multiple car crash and was in a coma. And that was Wednesday. Midterm was Thursday. I did extremely horrible on the midterm. I think I got like a 66. And that really brought down my average a lot on Pearson. Um, and then a week later, my father died. My father died last week.
Wow.
And it's been very tough, you know. And I missed today's homework. I wanted to do, but I've just been running around with lawyers and estate plans and so much of my father's things and insurance, and it's been very, very difficult period of my life. You know what I mean? And
Hmm.
I know I really don't want to ask this, but I was just hoping because I did miss a few homeworks. If you could allow me to please, I'm not asking to retake the midterm. I'm pretty sure if I did retake the midterm on good terms on a good day, you know what I mean, I could have done pretty well on it. But
Right.
with everything, um, but I'm not asking that. I did miss a few homeworks, and I was hoping if you would allow me to boost my grade up by doing them, please. That's all I'm asking for. Or if you
Let me
have any
see.
extra,
Let me see what you missed.
if you have any extra credits,
No, I don't have. I said that from the beginning. I don't have any extra credits.
yeah.
Hold on. All right. So, what have you missed? Wait, hold on. So you missed homework 3, quiz 3, homework 3, right?
Yeah.
Hold on 1 second. Let me see. Okay. So you're good to go. 3, 4, and 6 are good. You have till Tuesday. Okay?
Thank you so much, Professor. Thank you so much.
All right.
I don't know
Take
what
care,
else to
man.
say.
I'm
I
sorry about your
appreciate you.
job.
It's all right. Thank you. Thank you so much.
All right. Take care.
All right. Have a good weekend, Professor.
Okay.